about the vulnerability of these corporate loans to NPLs versus, say, SME loans or even consumer loans?
I think for the corporate loans, I guess they tend to be very like more big ticket items, and then a lot are also secured or
Less risky.
yeah, and the corporates they have track records also of I guess being able to pay back their debt, and a lot would also have longer running relationships, I imagine, with the banks.
In some ways, I would say much safer.
Yeah.
Based on what you said, yeah.
Hi everyone, I'm April Tan and welcome back to Intelligent Investing Market Talk series. Banks' first quarter earnings were up by 6%. While their lending income remained strong, this was largely offset by a sharp increase in provisions for potential loan losses as banks responded to slower economic growth, renewed inflation concerns, and geopolitical uncertainty. To help us make sense of the latest developments, we're joined by COL Financial's banking analyst Charmaine Co, who recently released her review of the first quarter earnings of listed banks. We'll discuss whether loan growth can remain resilient, why provisions have risen so sharply, which banks are best positioned if interest rates stay higher for longer, and of course, which banking stocks offer the most attractive opportunities today. Thank you, Charmaine, for joining us in the show.
Yeah, thank you for having me again.
Okay, so let's start with the bank's lending business. So during the first quarter, the net interest income grew by around 14%. I'm just curious whether this was driven by higher loans or higher net interest margins for the banks.
Yeah. So for the lending side of the banks in the first quarter, I think you can say that the results were still pretty solid, all things considered. We were seeing this growth being driven by both loans, like higher loan volumes actually, as well as higher net interest margins.
So both were good. So what drove the increase in loans during the first quarter?
For the increase in loans, I would say that it's been broad based this quarter. So we saw loans to businesses increase by maybe mid teens. I think like sector median. Also, consumer loans, we also saw them growing at maybe a little bit quicker than the business loans. So for the businesses, I guess maybe they would be still, I guess, borrowing to fund their working capital, or maybe towards March, maybe we've heard anecdotally that they're building up, some businesses are building up inventory.
Yeah.
Some
Before
are,
price increases.
yeah,
No?
or some are borrowing so that because in expectation of higher rates like later in the year. And then for consumer, similar consumer spending, mostly credit cards, personal loans. Those remain to be the quickest growth segments really on the consumer side.
I see. And what about margins? Why did they increase?
Yeah, so for the margins of the banks, I think we could say there's a few reasons, but maybe the ones I would highlight would be number one, we saw funding costs go down because of the BSP rate cuts last year. So that kind of thing, it sort of has a lag effect on the funding cost of the bank. So we're seeing the impact of it until now, until the first quarter. And then on the opposite side, while funding cost has been going down, I guess asset yield hasn't been moving as much as funding cost. So even if asset yields decline a little bit, the decline in funding cost is still steeper. Of course, the stability of the asset yield, it's also helped by a higher proportion of consumer loans. So as we know, consumer loans, they tend to have not just higher yields, but their yields are also stickier in the sense that it's less sensitive to general like BSP policy rate movements.
Yeah. And as you discussed, like consumer loans grew faster.
Yeah.
So their share is actually
Grow it,
increasing.
yeah.
Yeah. But I'm just curious about your thoughts on loan growth going forward. Of course, right now, there's still an ongoing Middle East crisis. So how would that And economic growth is also slowing down. So how would that impact loan growth? And even for margins with interest rates now trending higher, how would that impact margins?
Yeah, I guess I'll start with the loan growth outlook. So in terms of loans, first quarter was actually, for me at least, honestly surprisingly strong even. And then, but then I think moving forward, the macro backdrop has changed a lot. Like as you mentioned, the GDP outlook is now very different or much more muted compared to what we were thinking, say in January or February. So I think following that, the loan growth should be expected to moderate as well.
Are banks tightening their lending standards actually?
Yeah, that's also the thing. So apart from the banks, maybe some of them are saying already that expect less strong loan growth in the following quarters. They're also saying that they're tightening their credit standards. So they're being more careful, especially in terms of the consumer segment and I think the small business segment. They're being more careful now on which borrowers they're choosing to lend money to.
I see. And then for in the margins, interest rates going up, because of higher inflation.
Yeah.
So how will that impact margins? Or yeah, our margins are going to increase because of that.
Yeah. I think generally speaking, rising rates should be positive for the banks, at least in the beginning, since well as rates rise, it brings the asset yields, especially of corporate loans, which are very sensitive to like market interest rates as well as the BSP policy rate. So as the interest rates go up, the loan yields reprice higher, and then banks with I guess more substantial low cost deposits, their funding cost will stay
Sticky. No?
sticky, and then as you can imagine, the gap between the two or the spread as they call it, it widen. If you think about it, it should be a positive in terms of the interest margins. However, I think it would be also prudent to temper expectations on the margin expansion because, for example, there was a rate hike cycle in 2022 to 2023. And then the margin expansion then was explosive, is maybe the word I would use to describe it, because the BSP hiked really fast and then by a huge amount as well. And apart from that, they could also do that because the economy at that time was strong. Like the economy could take it. So parang compared to now, I don't think the margin expansion will be as impactful in terms of the net income pala of the banks.
Yeah, maybe as you said, no, what you said was interesting. During that time, the economy was much stronger. Right now, we have a weaker economic backdrop. So, yeah, what is the risk that banks face when they raise interest rates or they raise interest rates in a weak economic backdrop?
I think the risk for rising interest rates, I guess, in this kind of environment would be on the volume side. So as rates go up, maybe, and as general, if the economy is weak, so consumer demand maybe or spending is a bit weaker, then businesses might feel like, oh, maybe I won't borrow for
Borrow
now.
less. Yeah.
And then they'll maybe, if they have the cash, they'll try to pay down their previous borrowings.
Yeah. And in fact, they might even suffer from, or the banks might suffer from higher NPLs or non-performing loans as they increase the cost of borrowing. Okay. Um, so the in your report you talked about non-interest income in the first quarter actually going down.
Yeah.
What is the reason for this? And is it something that people should be worried about?
Yes. So for the non-interest income, it's basically the income of the bank that's not related to their lending business, right? So the components would be fee income, or if they sell foreclosed assets, like the gain on asset sales. The big and then another one of course is trading gains or trading losses. in this case, for this quarter, that was the biggest mover or the biggest driver in why the non-interest income came down from last year. So part of it is that I think five maybe out of eight banks they saw trading income turn negative, or
Trading
it came down, yeah,
losses.
trading losses,
Yeah.
or it came down in a quite significant way because the banks, right, have their investment securities portfolios, and then a portion of the investment securities portfolios are marked to market. So since the yields went up after the US Iran conflict, or the interest rates went up, the price of the assets will go down, and that's the mark to market losses that were booked in under non-interest income. I think that maybe I don't think it's that big of a cause for worry, since moving on, the change in interest rates wouldn't be as drastic as the first, like the initial spike. Yeah. So it should be tamer, I think, in the next few quarters. And then in terms of non-interest income as a whole, there's also some offset in the in coming from the fees that the banks collect.
So that's still healthy.
Yeah,
The
so
fees.
far, yes.
And then the major drag actually to profits was the provisions, since banks' provisions increased by around 47%.
Yeah.
Before we go into deeper discussion of what happened, can you explain to us what provisions are and why banks set aside provisions?
So provisions, you can think of it like the rainy day fund of the bank. So when a bank lends out money to borrowers, they have a certain expectation, or maybe the borrower won't be able to pay back the loan in full, or maybe they'll miss out on like a part of it. So banks are required by the regulatory authorities to set aside a certain percentage of their loan portfolio as provisions. And then the provisions are, well, they deduct from income. So that's why higher provisions would result in lower net income. But then on the flip side, if you think about it, that's also, I guess, it makes for a stronger balance sheet to have a greater allowance for loan losses.
So in a way, it's like so that they have an ability to absorb losses from their lending, no?
Yeah.
That it comes from the provisions.
Yeah.
Okay, so in the first quarter, again, we talked about the 47% increase. What's the reason for this? Did you actually see asset quality deteriorate, or are your banks just being, I guess, preemptive?
So it's actually both. And then I guess the answer then would depend on the bank. What we noticed is that for, let's say, the larger banks like BDO, Metrobank, BPI, their provisioning seemed to be more like precautionary, or they're front loading provisions. So in anticipation of maybe
Potential increase.
potential
Which
asset
may or may not
quality.
happen. Yeah.
Yeah, but so the idea is just that it might happen, it might not happen, but in either case, they want to be prepared.
Yeah, the buffers.
Yeah, so they want their buffers to be in place in the event that maybe the loss has to occur. And then I think for the smaller banks, like Security Bank, East West, I think, and then even RCBC. So some of these banks have been seeing some asset quality deterioration. So far, it's not really like broad. It's not broad. It's coming from very specific segments. But then that's a huge reason as to why they're provisioning so much. It's more in reaction to the deterioration in those specific parts of their portfolio, rather than as a precaution.
Okay. So overall, though, NPL ratio, or the non-performing loan ratio, has been quite stable and manageable. But given the weaker economic backdrop, what are the key indicators you'll be watching over the next few quarters to determine whether credit quality is becoming a bigger issue?
The key indicators that we'll be watching in the quarters going forward. Number one, I guess, still the NPL ratio per bank as well as for the whole sector and then for the Philippine banking system. Even though the NPL ratios now are still manageable, I think quarter on quarter we're seeing a slight uptick for some of the banks. So if it's like a slight uptick this quarter and next quarter, then before it goes down, like in fourth quarter and next year, then it's okay because there's a normal like seasonality to it also. But then what we would be watching for is if there's a persistent uptrend,
Mm.
and then
I think even the BSP announces them monthly, no?
yeah,
Yeah.
so that would be a more timely maybe
Yeah.
metric to check the BSP's
The
announcement.
monthly
Yeah.
reports, no? Yeah. Okay, so let's now talk about the individual banks. So given the current backdrop of rising interest rates and weaker economic growth, which banks are better positioned to, I would say, perform better or be more resilient? Are the big banks such as BDO, BPI, and Metrobank better positioned, or would it be the smaller banks?
And I think structurally speaking, looking at their balance sheets, I guess I would say that the big banks seem more, or they're more well positioned to
Stay resilient.
stay resilient in this kind of crisis or in this kind of environment. So it's because they have substantial low cost deposits, and then they also have the network to get more if they need. Apart from that, they have very adequate, around they have a lot of capital if ever the losses do occur. So they have sufficient capital to absorb losses. And then their loan books, at least compared to some of the smaller banks, are very heavy still on corporate loans. So as we mentioned earlier, corporate loans, the loan yields would reprice upwards in a period of rising interest rates, and that would help them in terms of the margins.
Yeah. What about the vulnerability of these corporate loans to NPLs versus, say, uh, SME loans or even consumer loans?
I think for the corporate loans, I guess they tend to be very like more big ticket items, and then a lot are also secure or
Less risky.
yeah, and the corporates, they have track records also of, I guess, being able to pay back their debt, and a lot would also have longer running relationships, I imagine, with the banks.
In some ways, I would say much safer
Yeah.
based on what you said. Yeah. So among the big three banks, BDO, BPI, Metrobank, which bank is your favorite and why?
So among the big three banks, maybe maybe for a to choose a bank in this time, I would choose maybe BDO or Metrobank. Because BDO in the first quarter, I was surprised by their strong loan growth. So that was attractive to me. I think that BDOs are it has the same like a heavier corporate um make or heavy corporate loans compared to consumers still.
Consumers.
Yeah, they have good CASA, and then they're, I think, a diversified bank in terms of what they're holding. Apart from that, their NPL coverage is very adequate, and then their NPL ratio compared to the other banks we've seen is quite stable actually, and still on the lower end, and if you compare across the whole sector. And then Metrobank is the same. It's like steady and reliable bank. Just its NPLs are also very low. The coverage is also very good. It's just that we're seeing loan growth for Metrobank trend a bit lower.
They're more conservative than
Yeah.
other
So
brands. Yeah.
in terms of earnings momentum, maybe we would favor BDO. Yeah.
I see. And what about BPI? Like what is the reason why you're not as excited about BPI?
Currently, I guess the concern for BPI would mainly be on their asset quality. I think their ability to generate loans is still strong, and I guess they're also the second largest bank maybe, and they have a lot of initiatives now that are driving asset growth like across the country. So it's really just for BPI. I think among the big three, they were expanding like in consumer segment,
Yeah, more
the
aggressively,
most
huh?
aggressively, and they've been looking for that growth also in, I guess, would you would describe it maybe as higher risk, or
SME loans maybe, right? Or
I think most
like mid business, like,
more, even the consumer. I think I think, how do they say this? Like they're going downstream a little bit, so they're reaching more, like
I guess
more
they're
people.
expanding
Yeah,
their market
there.
base. Yeah.
Yeah, that also creates a bit more risk for them in the asset quality space. And then we also, well, they did note that they're expecting to see stress in the consumer book as well as in the SME book. And we already saw the NPL ratios move upwards a bit this quarter. So that's why we're a bit more worried about them in the short term, at least.
Now I'd like to ask you about Metro Bank because it's the favorite of a lot of investors looking
Yeah.
for passive income because of its high dividend yield. Um, how resilient will these dividends be, based on your opinion, based on their capital adequacy or the earnings outlook?
So far, it seems like their dividends can be sustained. I mean, first quarter wise, looking at their earnings, it's still trending like as expected. So unless something really bad happens, like in the economy, I think that they will be able to sustain it. Their capital ratios are there, and I think that
And no
they're
need to be worried about
mm,
capital adequacy at this point.
yeah, and they took less risk, I think, in terms of like credit risk compared to the other banks. So I would say that their balance sheet maybe is a bit cleaner, and it would help them certainly to
Sustain,
sustain the
yeah.
dividends.
So now let's talk about the smaller banks. So I noticed that, for example, when it came to earnings, there are only two banks that outperformed your estimates, Union Bank and
Yeah.
PNB. But for me, Union Bank stood out because it was the profit growth was really strong,
Yeah.
um, by more than 100%. And while other banks were increasing provisions, it actually reduced the provisions. Um, does this mean that it's time to turn bullish on Union Bank?
In terms of Union Bank, yeah, I think that it's one of the more interesting earning stories coming out of the first quarter. And then the I guess the doubling of their net income from last year to this year was driven by the right reasons. So their credit costs or their provisioning came down from like 2 years of really elevated provisions, and then their NPL ratio, though still high, slightly improved. Their lending income is still strong. I think it's too early maybe to say that we're bullish on Union Bank. I would be more, parang the word I would use is like cautious optimism
Yeah.
for
So in
Union
other
Bank.
words, they're moving in the right
The right direction.
direction.
Yeah.
Yeah.
So it remains to be seen whether they can sustain it.
Mm-hmm.
So if they can really deliver in terms of the execution, because even if their provisions came down and their lending income is growing, Union Bank actually still has one of the highest credit costs. So credit cost is like provisions divided by
Yeah, yeah.
the total loans. It gives a sense of how large the provisioning is relative to the total loan portfolio of the bank. Among all of the banks, Union Bank is actually still one of the highest because it has a larger, I think around 60% of their portfolio is consumer loans. So with all that we mentioned previously, there could still be risks
Yeah.
that we don't see
But
right now.
definitely a bank that, you'd be watching.
Yeah,
Yeah.
yeah, definitely.
Okay. Okay, with that, thank you so much, Charmaine.
Thank you. Thank you for having me again.
Okay.
Thank you so much, Charmaine, for joining us and helping us better understand what's happening in the local banking sector. For those watching, I'd love to hear from you. Which bank is your favorite investment today? Let us know in the comments down below. If you found this episode helpful, don't forget to like, subscribe, and share this video with friends and family who want to become better investors. Once again, I'm April Tan, reminding you to stay sharp, stay selective, and as always, invest intelligently. Thank you for watching and see you again in the next episode.